As you say, we are a long-term investor, so we try to look through the noise of day-to-day things like the Fed moves. But we are in a rate reduction cycle, and that will bring us more to a normal level. And in some of our long-term programs, we are taking positions on where we think normal is for equities and rates and currencies.
So you've returned 14.9% for the latest financial year. I mean, not bad. International equities seem to be the biggest driver over the last 12 months or so. What was it?
Yeah, so global equities were a big component of our returns this year. Equities returned around 20%, and we've got an 80% equity benchmark. So yeah, around 15% was a good return. And the big component there is US tech, the AI story playing out into large cap US tech, where we have a big long position, mostly through our passive exposure.
Are you keeping those positions when it comes to those tech names that surged big time over the last 12 months and U.S. equities, U.S. exceptionalism in your portfolio? Does that stay intact?
Yeah, so we have a very large position to U.S. equities, but in our strategic tilting position, in our strategic tilting program, where we take long-term views on a valuation basis, we are slightly short U.S. equities. So we have a slight underweight to that long position that we have to U.S. equities.
Underweight U.S. equities?
That's right.
Where are you overweight then?
So we're overweight in some other equity markets. Japan is one of those. We're also overweight the emerging market region that we trade as a group in that program.
You've also reduced exposure to debt securities. Is it also the function of medium term, the cycle is changing and credit spreads are pulling back?
Yeah, that's true. One of the things, we have a total portfolio approach, and we also have this long horizon, so we don't have to always be fully invested in everything. And if we see credit spreads are tight, or that there isn't an opportunity in an asset class, we will pull money away from that and reduce our exposure.
Okay. The basic idea that I want to get out of you, reference portfolio that you guys working up against, that you have set up internally, is 80-20 equities versus a fixed income. What's the idea there? Why is it not 60-40? That seems like a safe idea for a lot of people at the moment, no?
Yeah, that's true. So we have a very long horizon relative to some investors, and so we think that in the long term, risk will be compensated with return, and we need to take an appropriate amount of risk to deliver on our long-term objective. And our board has chosen 80% equities as an appropriate benchmark for us. As you mentioned, we have around half of the portfolio invested passively into that, and we have the other half invested in active strategies that take different positions relative to that.